with interest rates at an incredible all-time low. You might be considering refinancing your house and wondering, is it a good time? Are rates low enough compared to what I currently have? What are the closing costs? And should I roll those into my loan? All of this and so much more is covered in this video. Hi, I'm Amy, and this is You Don't Know What You Don't Know. If this is the first time seeing me, I do this every month, the first Sunday at 2 p.m. Eastern Time. If you'd like to join me live, you can find that link below. If you find this information useful, give me that thumbs up or like button and subscribe to my channel, as well as clicking that bell icon, and you'll get notified the next time I upload a video. Now let's get started. So many people nowadays are looking at refinancing. Interest rates are at an all-time historic low, and I just refinanced. I used to be, for those of you who don't know, I used to be in the mortgage business. I used to be a mortgage broker for over 10 years, and I haven't done it for quite a few, but some things are just slow to change. So whether you're buying or refinancing, this information is going to be great. Like I was saying, my husband would pester me and say, let's refinance, let's refinance, let's refinance. And what people don't understand is that there is a cost to refinance, and it's not cheap. It is typically about $8,000 to refinance your home. And so many people are like, yeah, but it lowers my payments. Yes, it does have the potential of lowering your payments, but at what cost? At what cost? And so we're going to talk a lot about this today because it is very important to realize the financial benefit or detriment to refinancing. All right. The first thing that people constantly ask is, when should I refinance? How low should the rates drop for it to be advantageous for me to refinance? In the sense of refinancing, my rule of thumb is they need to drop about 1 point. Now, when I purchased my home, I got an interest rate of 4.5 on a 30-year fixed, which I thought was fabulous at the time. And as you know, rates have plummeted. They are down in the mid to upper twos, depending on your situation. And when they dropped to 3.5, my husband was like, "Should we refinance? Should we refinance?" What you need to determine is how much is it going to save you if you refinance? How much are your payments going to drop, and how much is it going to cost you? And I say that because what happens is when people quote you a rate, they quote you a rate with you paying closing costs. And like I said, typically the closing costs are about $8,000, depending on the cost of your home. It could be more, it could be less. And so if you're going to pay those $8,000, but you're only going to save $100 a month, then you do the math. It's going to take you quite a long time to recoup the benefit of the lower interest rate if you're paying $8,000 to get it, right? If you're paying $8,000 to 100 into 8, that's like 800 months. So that's a long time. Maybe you're not planning to be in the house that long. As a matter of fact, most people are not, even if they stay in a house for 30 years or for a very long time, most people are not in a mortgage more than 7 years. It's 7 years on average, because you're either refinancing because you want to lower your interest rate, or you're refinancing because you want to pull cash out, or because you want to roll two loans together, or perhaps you are currently in a loan that you're having mortgage insurance and you want to get rid of the mortgage insurance. There's a variety of reasons why people refinance, but most people don't stick in the original loan for 30 years. So, first of all, be aware of that, and be aware of the cost to see what the benefit and the break-even point is of paying those costs. That's really important. That's the first thing. So when I did the math, I decided that I didn't want to pay those closing costs, is what I told my husband. I don't want any money out of my pocket. And in order for you or me to not pay closing costs, that means you have to get a little slightly higher rate, because with each higher rate, you get what they call a rebate, or the rate. It's a complicated issue, but with a slightly higher rate, you won't need to pay closing costs. And so I was waiting until I could get a rate that wouldn't allow me to pay closing costs and would still be advantageous for me to refinance. Now, some of you might be saying, Amy, I just rolled my closing costs in. That's fine, except realize that you are now paying interest on that $8,000 of the closing costs. Yes, you can write it off, but with the interest rate so low and the interest so low, you're only writing off a portion of that. And so why would you want to pay interest on the $8,000 or the $6,000 or whatever it's going to cost you to refinance? In the past, when I didn't know better, I did. I rolled in the closing costs and I paid the interest on the closing costs. But just realize that is a decision you need to make on whether or not that's beneficial for you. Maybe you'd like you aren't going to be in there forever and it's negligible on the additional monthly payment, and you need to do the analytics behind that to see if it's advantageous for you to roll in the closing costs or not. But typically it's better for you to not roll in the closing costs. And in my case, I didn't even want to have to pay them out of pocket. So I got a rate that was slightly higher and had my broker pay my closing costs, including my prepaid items. Now, what's the difference? Closing costs are the costs to get title insurance, get the appraisal, and all of that. Prepaids are what you do to set up your new escrow fund, your new fund that's going to be paying for your taxes and insurance. Sometimes I would advise people to maybe pay to set up your prepaids, not all the closing costs, but maybe set to pay your prepaids on a refi, because when you close out your current account, you will get refunded what's in there, and it should be pretty much a wash. So if you didn't want to roll in closing costs, but you didn't want the higher rate, you could opt to just get a rate that covers everything except setting up your escrow funds, knowing that you'll get reimbursed when your current escrow funds close. I hope that's clear. So that is another option. Let's see, what else? I did cover how much it costs. I covered how much the rate should drop. I don't typically advise people, or I didn't when I was in the business, to refinance when it drops unless it drops more than a point. And you really need to look at what that means on your payments and see if it's advantageous, again, with how much you're paying in closing costs, whether or not that's going to be worth it. Because the smaller your loan amount, the less impact it's going to have on your payment, the less the interest rate will have on your payment. So if you've got a loan of $600,000 and your interest rate is 2 3/4 versus loan at $300,000 and an interest rate at 2 3/4, it's not as big a difference because of the amount being borrowed or the amount being loaned. So just know that you need to do the math to see what kind of savings you're going to get monthly. I hope that helps. All right, I have some other things. Buying down the rate. You guys, so many people would want to buy down the rate. I will tell you that most of the time it's not in your benefit to buy down an interest rate. Let me explain why. In order for you to buy down the interest rate a quarter of a point, it costs you 1% of the loan. So if your loan amount is $450,000, it's going to cost you $4,500 to save a quarter of a point. And you're like, yeah, but Amy, that's the difference between 3% and 2 3/4%. Yeah. And in a loan amount of $450,000, that's less than $60. So you're going to pay $4,500 to save $60? Really? That's kind of crazy. But nobody typically tells you this. So I'm here to tell you something you don't know what you don't know. Don't buy down the rate. The only reason I would advocate buying down the rate is if you can't comfortably afford the payments on your current cash flow. If you have an abundance of cash, right? And so you want to, even here, it's making me kind of cringe. But some people who say, I've got enough money in the savings in the bank that I would rather buy down the rate, so over time I would save the $60 a month. Really? It would take you over 6 years. And like I said, most people are only in a loan 7. So it doesn't make sense, you guys. For most situations, it does not make sense to buy down the rate. And if any of you need some assistance in walking through the numbers, by all means, leave a comment and we will connect and I will run the numbers and show you whether or not it's advantageous for you to buy down a rate. 99.9% of the time, it is not. It is just not. It's a lot of money to buy down. If you could pay $4,500 and buy it down a whole point, maybe, but most of the time you're only buying it down 1/4 of a point, which is nothing. It sounds like a lot, but it's really not. Let me see. Carolyn, I pulled my taxes and insurance out and pay it on my own rather than escrow on my investment property. Okay, good point. Just to let you know, this, and you might not have known this, you pay 1/4 point more in your interest rate to do that. The reason why you pay 1/4 point more in your interest rate in order to do that is because that is a huge risk for the bank to take. The bank needs to trust that you are not going to default on your taxes or insurance, and the property that they hold a note on will not become uninsured or get a tax lien against it. And this is a huge leap of faith for them. So for that leap of faith, they charge you 1/4 point more. So I don't know if you realize that. And in all honesty, it's a nightmare for at least for me. It's a nightmare for me to manage that. I would rather pay 1/4 point less, pay a little bit into the escrow fund every month and have someone else have to deal with it. But if that's something that you want to control, just realize that there is a cost to that because it actually costs you more in your rate. Another question that I get a lot of times, whether they're refinancing or purchasing, is should I get a 30-year or a 15-year? And some people ask for a 20-year. There's not a whole lot of difference between the 20-year. Something that you need to know is that if you're in a mortgage, a 30-year mortgage, and you're in it for 8 years or more, if you refinance, you're refinancing and starting all over again at 30 years. And the way mortgages work, they front load the insurance. So in the beginning, the majority of your payments are just interest, not insurance. They front load the interest. So the majority of your payments in the beginning of any loan are like 9/10 just interest rate, and you're paying down the principal or the balance very little. And so if you're 8 years into a loan, you have done majority of just interest, not a whole lot of principal, and now you're restarting the clock, which is fine as long as you realize that's what you're doing. Especially if you're getting closer to like 10 years into a loan you can start the clock all over again. Just realize that when you do, the majority of your payments are once again going to be interest and not a whole lot of principal. That is why a lot of times people will refinance into a 15-year mortgage when they get past a certain point so that they're not paying so much in interest. Now, when I refinanced, where am I? I'm like 7 years into my loan. 7 years into my loan. And I was looking at refinancing. My husband and I thought, you know what? Instead of restarting at 30-year again, let's do a 15. We'll get it paid off in 15 years, and we will have saved ourselves 8 years, right? Because 30, what was I thinking? Yeah, 30 minus 7, and then I've got a 15-year note. That means I'm saving 8 years of payments. But because we're now paying it off in less time, the payments, even though the interest rate is lower, the payments are typically higher. Now, what we were trying to do is we were working on getting the rate so low on a 15-year that the payments would have been the same. So as I said, we started at 4.5. When the rates got down to be 2.5, we were almost paying the same amount on our mortgage at 15-year as we were currently on a 30-year. And so we were going to drop it down. It was a little bit more. It was a little bit more, but it wasn't anything drastic, right? I think it was a couple $100 more. And I thought long and hard about this. And we had started the loan process and turned in all of our docs and all of that. And then it occurred to me that there is another way to pay your loan off quickly in 15 years, but not be required to pay it off in 15 years. So let me explain. What I ended up doing, and you can do the math, is we ended up refinancing back into a 30-year mortgage. Stay with me here. We did a 30-year mortgage, but we said we're going to pay what we would have paid had we gotten a 15-year mortgage. And doing that, we'll pay it off in 15 years. Why would we do that as opposed to just getting a 15-year mortgage? We did that because then it's our choice. Right now, we're in a very volatile time. And not knowing exactly what was going on with our household income, we wanted to make sure that our fixed expenses were as low as possible. So while we can afford to make the 15-year payment, now, if there was ever a time that we couldn't, we could fall back and pay less and still be good with our loan, not default on our loan, and not pay it off in 15 years. We could manage our cash flow a little bit better. So for those of you who want to pay your mortgage off early, but you want to manage your cash flow and it fluctuates maybe year to year or moment to moment, you can manage them better if you take the mortgage that's a 30-year, and on the months that you have more to pay more, and on the times that you don't, you don't. You just make additional payments, or you make bigger payments monthly. Just make sure that when you make those payments that you're allocating the additional funds that are not required toward principal. They need to be allocated. A lot of times they'll end up being put into a certain fund and it messes everything up. Make sure that the additional payments are being put toward your principal only, not into a forbearance account, which is what typically happens if the bank doesn't know what they're supposed to do with the additional funds. They think you might be prepaying the following month, and that's not the case. You actually want to pay a payment on the principal. Just make sure you're notating that clearly to the bank and make sure that it gets allocated correctly. So that's something else that you can do if you decide that you want to pay it off early, but you want to manage your funds and your cash flow. Get the 30-year and make additional payments. That way you actually end up paying less interest, and you can get it paid off even earlier. And you're making the same payment as if you had checked out, as if you had gotten a 15-year anyway. You just have the flexibility. Does that make sense? I hope that makes sense. All right. One of the last things that I want to cover today, and then I'm going to go into an actual example, and that is cash out. Nowadays, so many people are looking to do renovations and add-ons and additions and things like that to their home, updates to their home. And they want to take money out of the equity because some of us have, equity in our homes. We want to use that equity in order to do remodeling or additions. Is this a good idea? You need to really sit down and analyze. Many cases it is because the money that you take out of your mortgage is part of the mortgage, and currently, at least in the United States, you can still use the interest on your mortgage as a tax deduction. So you're borrowing the money and you're being able to declare it on your taxes, which is different than a personal loan, which you wouldn't be able to. So that's first of all. Second of all, realize that, again, you're going to be paying interest on that money that you're pulling out. So, whereas if you had a personal loan, it would be for a certain duration, like 5 years, and you'd have the money paid off. You get to spread it out over the duration of the loan, but you are going to be paying interest on that money. I guess you're going to pay interest either way. At least this way it would be tax deductible. Some people decide to keep the, instead of refinancing, to just do a home equity line of credit. That can also be utilized as a tax deduction. And so that is it, and that's a separate loan that stands by itself, so you can pay that off sooner if you want. But if you don't want to have a second one, you just want to have one loan and you want to pull everything out at one time, you can do a cash out refi. Something to know about a cash out refi is, again, many people, when they're investigating rates, they're wondering, why is the rate slightly higher? Well, there are a variety of reasons. We know that credit score has a huge impact. Also, the amount down has a huge impact, or how much equity you have in your home has a huge impact. And, cash out. Or if you, like Carolyn said, if you want to do your own escrows, that's going to be a bump in your rate. So there's a variety of things that can bump your rate one way or the other, and you just need to be aware of it. Now, the final thing that I want to share with you is, how much does that really impact us? This whole rate thing. We're so trained to chase the rate. I want to get the lowest rate. I want to get the lowest rate. I want to get 2.5. I want to get 2.25. So I actually ran concrete numbers for you guys. And I took a loan amount of $450,000. If you take out a loan for $450,000 at an interest rate of 2.5, and we're not going to go into all the other caveats, how much, equity and all this other stuff. If your loan amount is $450,000 and the interest rate is 2.5, that comes to just a principal and interest, without taxes and insurance, just principal and interest of $1,778. $1,778. So then I ran the same scenario, $450,000 loan with an interest rate of 2.75, just a quarter point more, right? The payment was $1,837. So do the math. When you take 1778 from 1837, you're left with $59. $59. That's it. That's it. The difference for a $450,000 loan, the difference between 2.5 and 2 3/4 is a $59. So when you just miss it and you get an interest rate of 2.625 instead, in between, that's like an interest rate. That's a $30 difference. For each eighth of a point difference, it's $30. And so often we sweat it and we get angry with ourselves when we're not able to lock in on that eighth of a point lower. It's $30. Don't beat yourself up. You're probably saving a substantial amount. $30 isn't going to be that, make or break the deal, right? In my case, I saved $1,000 on my mortgage a month. $30 isn't going to make it either way. And the way that I looked at it as the little bit that was going to be the difference between the 2.5 and the 2 5/8, or the 2.625, the little bit difference, I didn't have to come up with that money at closing because I took the slightly higher rate. And in order for me to break even was so far in the future that it just didn't make sense. So run the numbers. I'm trying to tell you, don't get so hooked on a rate, because the difference of an eighth of a point is very little. Very, very little. That's number one. Number two, don't constantly refinance every time the rate drops to, a half a point, because it costs you a lot of money every time you refinance. So wait until it drops a decent amount and then determine whether or not you want to pay the costs, or whether or not you want to get a slightly higher rate, or whether or not you want to roll those closing costs into the loan. And with that, I truly hope that the information that I've shared has allowed you to know something that you didn't know, and will help you when you either go to purchase or to refinance your home. I want to wish you a sensational, serendipitous, sunny, soulful Sunday, and I look forward to talking with you again next month. Have a good one, guys.